Today we are tackling a really big one, a major economic debate, modern money theory, or MMT. If you've been following macro discussions, you've definitely heard the big claims that, governments that issue their own currency are monetarily sovereign, they can't default.
Right, and then inflation, if it pops up, can just be handled by raising taxes, pull the money back out.
Exactly. And I mean, let's be honest, it sounds incredibly appealing, almost like a pathway to unlock massive government spending, kind of like finding a magical money tree that solves debt problems.
And that appeal, that very powerful promise, is precisely why we're looking at this source material today. It's a highly structured, quite detailed critique.
And it doesn't just disagree with MMT, does it? It frames it quite strongly.
Oh, yeah. It calls MMT a false theory.
Yeah.
More than that, it argues MMT is strategically designed to hide fundamental flaws in our current system, the debt money system.
Wow. Okay, so not just wrong, but actively misleading, according to this view. That's a huge challenge.
It is.
So our mission today isn't about picking sides or endorsing one view over the other. It's about really understanding the specific arguments in this critique. We're going to use the financial data, the macroeconomic modeling presented in the source, to unpack 7 specific points, 7 falsehoods that these critics identify in MMT. And they're arguing mainly from the perspective of what they call a public money system.
Right, contrasting the two. And the stakes, well, according to this analysis, they couldn't be much higher.
How so?
The source material actually uses this stark analogy. It warns that the kind of aggressive debt-fueled spending MMT seems to enable is like trying to save a falling airplane by revving its engines harder.
You mean hastening the crash?
Precisely. Hastening the inevitable crash is the phrase used. The argument is the crash is built into the design of the current debt money system, and MMT, in this view, just makes it happen faster.
Okay, that's a powerful image. We definitely need to understand the mechanics behind that warning. Right. Let's get into it. So the conflict, it seems, starts right at the beginning. Like, what even is money? MMT says money is fundamentally an IOU, a certificate of debt.
That's the foundational definition for MMT.
Which means, doesn't it, that MMT basically assumes from the get-go that the current way money works as debt is the only way it can work, or at least the only way that matters.
That's exactly the critique's starting point. They call it a prejudice baked into the theory. By defining money only as debt, MMT is essentially describing the reality of, say, the last century or so.
And ignoring what came before.
Exactly. The source points out that right now, in an economy like Japan, something like 99.7% of the money circulating is debt money. It's created when government, firms, or households borrow. So MMT describes that part accurately.
Okay, 99.7% is almost everything.
It is, today. But the critique says, hang on, this definition completely excludes over 1,000 years of monetary history where money wasn't primarily debt.
You mean like before central banking as we know it? What kinds of examples are we talking about?
Well, the source gives specific examples, like the Japanese Wado Kaichin coin, introduced way back in 708 AD.
Wow, okay.
That was issued by the government, interest-free, just as a medium of exchange, not a debt instrument. Or you can go even further back, 7th century BC, Lydia, the first known coins, Electrum.
Also not debt.
Also not debt. These were public monies. So the critique argues the MMT definition is sort of conveniently narrow, focusing only on the debt money issued by modern institutions like the Bank of Japan, which, only started in 1882.
It seems odd, though. MMT often presents itself as challenging mainstream economics. So why would defining money purely as debt be, as the critique puts it, convenient for international bankers? That sounds counterintuitive.
Well, that's the irony the source highlights. Think about it. If you accept that money must be an IOU, then you inherently justify the current system.
The system where banks create most money as interest-bearing loans.
Precisely. That 99.7% reality. If money is debt, then the creation of money as debt by banks becomes the natural, maybe even the only legitimate way. It shuts down the conversation about alternatives, like interest-free public money.
So the definition itself defends the status quo in this view.
That's the argument. It defends the fractional reserve system and the whole structure of earning interest on money creation. MMT, by accepting this narrow definition, is seen as unintentionally reinforcing the very system it sometimes claims to critique.
And what about the MMT link between taxes and money? That taxes give debt money its value.
The critique dismisses that too. It argues MMT conflates two different things: the monetary system, what constitutes legal tender, and the tax system.
How are they distinct in this view?
The source insists on a clear distinction. There's legal tender, which is currency established by law, like coins and central bank notes. And then there's functional money, which is basically bank deposits created out of thin air by commercial banks when they make loans. These are the IOUs.
And MMT blurs this line.
Yeah, the critique says MMT treats this functional bank-created money as if it's the same as genuine legal tender. This blurring is seen as, well, again, convenient for international bankers because it legitimizes the private creation of money as debt. The source even sometimes refers to this functional money as counterfeit money.
Strong language.
It is. The point is, if private banks control the creation of the vast majority of the money supply through credit, functional money, the government loses real control regardless of its power to tax. Taxing can pull money out, sure, but it doesn't stop the private creation of new dead money.
Okay, that definition issue is fundamental. What's the second big point of contention?
It's a methodological one.
Yeah.
MMT often simplifies its models by assuming what it calls a consolidated government.
Meaning they lump the central bank, like the Fed or the Bank of Japan, together with the Treasury Department, treating them as one entity on the balance sheet.
Exactly. They integrate the balance sheets.
And the appeal there is pretty obvious, right? If the central bank owns government bonds and you consolidate them,
then it looks like the government owes the debt to itself. So you could just write it off or argue it doesn't really matter. It makes those huge government debt numbers seem much less scary.
A neat theoretical trick. But the critique says,
it says this is factually wrong and methodologically unsound. Factually, central banks, even if partially state-owned, like the Bank of Japan, BOJ, with its 55% government stake, have significant operational and often political autonomy.
So the government doesn't just tell the BOJ what to do?
Not really. The critique poses this question. How can the debtor, the government, realistically have ultimate political power over its main creditor, the central bank? Especially when that creditor controls the monetary system.
Right, the power dynamic is skewed the other way in practice.
Exactly. Assuming that one entity ignores these crucial institutional realities and power structures that exist right now.
Okay, so that's the factual issue. What about the methodological problem? The critique says even if you did move to a public money system, you'd still need separate balance sheets. Why?
It's all about clarity and accountability. For proper economic analysis, especially what's called flow of funds analysis, you absolutely need to track the money moving between the entity that issues a currency, whether it's a central bank or a future public money administration, and the entity that spends it and manages fiscal policy, the Treasury.
If you consolidate them, you lose that trail.
Completely. You can't see where money originates, how it moves, what impacts it has. It could hide inflation, irresponsible spending, you name it. It makes proper oversight impossible.
So the source material is really firm on this.
Absolutely adamant. It states that consolidating the government and central bank balance sheets is theoretically and practically impossible for sound analysis, whether you're talking about the current debt money system or a proposed public money system.
So the critique sees this consolidation purely as a way for MMT to avoid confronting the real structural problems and constraints imposed by having separate fiscal and monetary authorities, especially when debt is involved.
That's the essence of it. That separation, however imperfect, creates some checks and balances. Consolidation, in theory, removes those checks, paving the way for the kind of potentially unlimited fiscal expansion MMT talks about, which the critique argues leads straight to instability.
Okay, let's get to probably the most famous MMT claim, the one about monetary sovereignty, the idea that the government can issue its own currency.
Right, this is central to their argument.
But the critique argues the statement itself is deeply misleading, that it confuses two totally different things: borrowing money versus actually issuing it.
That distinction is absolutely critical to the critique's argument. Let's break it down for the current system. When a central bank, like the BOJ, issues currency, we're talking actual Bank of Japan notes or the electronic reserve deposits banks hold,
Okay.
it records those as liabilities on its balance sheet.
Right.
Something has to back those liabilities, right? An asset. And what's the main asset the BOJ holds against these currency liabilities?
Government bonds. JGBs in Japan's case.
Primarily, yes. Japanese government bonds. So think about what that means. The central bank is issuing its currency against government debt. The currency comes into existence because the government borrowed.
Ah, so the MMT claim government can issue its own currency really means
The government can issue its own bonds, its own debt, denominated in its own currency unit. It's fundamentally a statement about the government's ability to borrow, not its ability to create base money directly, interest-free.
That's a very different framing, and we already established that this government borrowing is only part of the total money picture, right?
Exactly. Remember that split? We looked at M3 money supply in Japan. Roughly 48% comes from government borrowing, but 52% comes from private sector borrowing companies and households taking out loans.
So if MMT insists money is IOU, why the heavy focus on the government's 48% share? Why downplay the majority created by the private sector, which arguably drives day-to-day economic activity?
The critique argues it's strategic. It allows MMT to position the government as the primary actor, the economic savior whose spending drives everything, while overlooking the massive role of private credit creation.
But hang on, the government does issue some currency directly, doesn't it? Like the coins in your pocket.
It does, and the critique uses the small example coins to actually prove the separation between the government and the central bank, and to show what true issuance looks like.
How so? Coins are public money.
Yes, coins are the tiny fraction, just 0.3% of circulation in Japan. About 4.8 trillion yen that represents genuine, interest-free public money issued directly by the government today.
Okay.
Now, the source details the incredibly complicated accounting hoops the Bourget has to jump through just to handle these government-issued coins when they enter the banking system. The government deposits them, and the Bourget uses special accounts, almost like juggling them separately.
Why would they need such complex account manipulation, as the source calls it, for such a tiny amount if they were truly consolidated?
Exactly. If they were one entity, it would be simple. This complex handling of the 0.3% proves they are separate. And it highlights that the government's main role in the current system isn't issuing the functional currency we use, but borrowing debt money from the banking system.
So the correct conclusion, according to the critique, isn't that the government can issue its currency, meaning debt, but that the government could issue its own public money interest-free if the system were different.
Precisely. That's the potential the critique points towards.
All right, this leads directly to the big payoff claim for MMT. A country that issues its own currency, has debts in that currency, and a floating exchange rate simply cannot go broke. It can't default. It can always print the money.
This is probably the single most appealing and widely cited MMT argument.
But the critique, again, offers a completely different interpretation of what cannot default actually means in practice.
It does. It essentially says cannot default doesn't mean the debt magically disappears. It means the government can always manage to roll over the principal amount of its debt.
Meaning, when bonds mature, they just issue new bonds to pay off the old ones, refinancing indefinitely.
Exactly. Refinancing the principal, often forever, while only needing to find the cash to pay the ongoing interest.
And from the perspective of banks or bondholders, that's actually good news.
It's the preferred scenario. It keeps the government perpetually indebted, generating a reliable, long-term stream of interest income flowing from the public purse to the financial sector. Cannot default means can stay in debt for a very long time.
So avoiding a government default just keeps the debt machine running smoothly for the creditors. That's a cynical take.
It's central to the critique's view of the system's design. And this is where the critique argues MMT ignores the real danger, the systemic consequence.
Which goes back to the private sector.
Yes. Remember, MMT elevates the government role. But the source says the private sector, creating 52% of debt money, doing most business, is the real engine. Government borrowing is often secondary, stepping in when private borrowing falters.
So what happens if the economy stagnates, like Japan's lost decades? Growth stops, but the interest on that huge government debt still needs to be paid.
Now, the government has only two real choices, assuming it won't or can't just create interest-free money.
Raise taxes or borrow even more.
Right. And this is the pathway to what the source calls debt hell. If the government raises taxes to pay the interest, who pays?
Firms and households, the private sector.
Correct. This drains their net assets, their equity. If this goes on long enough in a stagnant economy, the private sector itself becomes insolvent. They default. So the MMT claim that the government won't default might be technically true for a while, but only if you ignore the fact that it could be driving the entire private economy into the ground.
That's a grim picture. What's the alternative path in this dead hell?
If the government decides not to raise taxes, but instead borrows more money just to pay the interest on its existing debt.
That sounds like a death spiral.
It is. It's a classic debt spiral. The total debt grows exponentially faster and faster until you reach a breaking point. Catastrophe. That could be a financial market meltdown, hyperinflation, or even eventually a sovereign default when no one, not even the central bank under political pressure, can absorb the sheer volume of debt anymore.
And lurking beneath all this is the issue of Who benefits from those interest payments?
That's the constant refrain in the critique. Those interest payments represent a massive, ongoing transfer of wealth. It's unearned income flowing from taxpayers or future borrowing directly into the pockets of the banks, the bondholders, the financial elite, the 0.1%.
So it structurally embeds and worsens inequality.
Year after year. That's why the critique reaches the complete opposite conclusion to MMT. Under a debt money system, producers, households, and governments that issue currency as debt are all ultimately headed towards default, and that process usually starts with the crippling of the private sector.
Okay, but MMT proponents have an answer for the inflation risk, right? If all this government spending or debt monetization creates too much money chasing too few goods, they say the government can just raise taxes, pull that excess money back out of circulation, cool down demand, problem solved, controls inflation.
Right, that's the theory. The critique argues this is a fundamental misunderstanding, or perhaps misapplication, of how money is actually created in our system, something MMT itself often highlights, the endogenous money theory.
How does endogenous money undermine the tax solution?
Well, MMT correctly observes that government borrowing can increase the money stock. That's the 48% share we talked about. But the crucial failure, according to the critique, is ignoring the other major source of money creation: private banks making loans.
The 52% share.
Exactly. And the government has virtually no direct control over that private credit creation faucet. So when the government raises taxes to fight inflation,
It's like trying to drain a bathtub while the tap is still running full blast. Or maybe even harder.
that's a great way to put it. Raising taxes only closes the government's 48% faucet. But what happens when inflation really takes hold? People and businesses expect prices to keep rising.
They want to borrow more money faster to buy things before they get even more expensive.
Precisely. Demand for loans surges. And private banks, seeing profitable lending opportunities, are more than happy to open their 52% faucet wide, creating even more debt money out of thin air. The government's tax drain becomes completely overwhelmed by the private credit flood. The total money supply spirals upwards.
Making the inflation worse, not better.
Exactly. And at some point, this becomes visible internationally. Foreign investors see the currency rapidly losing value. They lose confidence.
They start selling the currency, say, the yen.
Right. The exchange rate collapses. Suddenly, the cost of essential imports, think oil, gas, raw materials, absolutely skyrockets. This isn't just demand pull inflation anymore. It's severe cost push inflation layered on top.
And that's the trigger for hyperinflation.
That's the scenario the critique lays out. It becomes an uncontrollable spiral.
And the source argues that history shows fiscal tools like taxes are basically useless once that fire starts.
It points directly to the example of post-World War II Japan. The government was facing raging hyperinflation. They tried everything fiscally: emergency economic laws, forcing people to deposit money, new property taxes, even outright confiscation of assets, all designed to pull money out of the system.
And did it work?
Total failure. The inflation continued to savage the value of the currency, wiping out savings, pensions, everything. The source argues it wasn't fiscal policy that eventually stopped it.
What was it then?
It was an external fix by the Allied occupation, GHQ, in 1949, setting a fixed exchange rate of 360 yen to the US dollar. But that only came after the hyperinflation had already destroyed the economy and people's lives.
So the lesson learned, according to this critique, is that MMT's reliance on taxes to control inflation within a debt money system is fundamentally flawed because it ignores the uncontrollable private credit channel, and history shows it doesn't work in a crisis.
Correct. The critique concludes that only a public money system, where the government directly controls the total quantity of interest-free money being issued, has the actual tools needed to maintain genuine price stability.
All right, let's move to maybe the most politically attractive MMT idea, the slogan. Their debts are our assets.
You hear that one a lot.
It implies that when the government borrows and spends, it directly increases the financial assets, the bank deposits of the private sector. Like, it's a net gain for us, the public, and nobody really loses.
It sounds like a win-win. Government gets to spend, private sector gets richer.
But the critique argues this is a dangerous illusion, basically hiding how the system really transfers wealth over time. And it uses a detailed balance sheet analysis to show this.
Yes, this is crucial. We need to walk through the steps carefully, using the source's example. Imagine the government decides to give an 80 billion yen subsidy to households. It tracks this across 4 sectors: government, private sector, households, firms, banks, and the central bank.
Okay, step 1. The government needs the money first.
Step 1, borrowing. The government issues 80 billion yen in bonds. That's a liability, a debt, for the government. To balance this, its deposit account, an asset, increases. Commercial banks typically buy these bonds, increasing their assets, possibly using reserves they hold at the central bank, which would decrease those reserves.
Okay, government has borrowed the $80 billion, now it spends it.
Step 2, spending. The government transfers the 80 billion yen to households, the private sector. Now, the private sector's bank deposits go up by 80 billion. That's their asset increase. Their net assets also increase by plus 80 billion. At the same time, the government spent its asset, the deposit, so its net assets drop to negative 80 billion.
Right. And this is where MMT proponents often stop the analysis, isn't it? They say, see, private sector assets are up 80 billion, government assets are down 80 billion. It balances out.
Exactly. It looks like a simple transfer. The non-banking sector combined, government plus private, has a net change of zero. Negative 80 plus 80 equals zero.
Yeah.
Money was created, assets shifted. Seems fine.
There's a cost missing.
The cost of the debt. Banks didn't buy those bonds for free. There's interest. This is where the illusion breaks down over time. Let's follow the example into steps 3 and 4. Interest payments.
Okay, let's say the interest rate is low, like 1.25% per year on the 80 billion. That's 1 billion yen per year. Over, say, 10 years, that's 10 billion yen in interest due.
Right. Now, where does the government get that 10 billion yen to pay the banks? It can't just create it interest-free in the system.
It has to tax someone.
It has to tax the private sector. So the government collects 10 billion yen in taxes from households and firms. What does this do to the private sector's balance sheet?
Their assets, deposits, go down by 10 billion. Their net assets also decrease by 10 billion.
Correct. And what happens immediately with that tax revenue? The government doesn't keep it.
It pays it straight to the banks as interest income.
Exactly. So the bank's income goes up by 10 billion and their net assets increase by 10 billion.
Okay, let's pause and look at the final picture after 10 years of interest payments. The government's net assets.
Still necked 80 billion yen. The original debt principal hasn't been paid.
The private sector's net assets. They started at plus 80 billion, but then paid 10 billion in taxes.
So their net assets are now only plus 70 billion yen.
And the banking sector's net assets.
They are up by plus 10 billion yen, the interest received.
Wow. So if you look at the whole non-banking sector again, private plus government, their combined net position is now negative 10 billion, negative 80 plus 70. And the banking sector is plus 10 billion.
Precisely. The initial plus 80 billion gain for the private sector was temporary. Over time, the interest payments systematically drained 10 billion in net assets from the private sector via taxes and transferred it directly to the banking sector.
So the slogan, "Their debts are our assets," is misleading because it ignores the interest cost, which ensures that government debt ultimately drains assets from the general public to the financial sector.
That is the core conclusion from the source's balance sheet analysis. Government borrowing under a debt money system isn't a free lunch for the private sector. It's a mechanism that structurally, mathematically transfers wealth upwards, embedding inequality into the system year after year.
Okay, that wealth transfer point is powerful. Let's look at the last falsehood identified. MMT's claim that spending comes first.
Right. The idea that because the government is the issuer of the currency, it must first spend money into the economy before it can possibly tax it back.
It sounds logical on the surface, like you can't collect apples before you plant the tree.
Mm-hmm.
But based on the mechanics we just discussed, particularly that balance sheet analysis for the debt money system, it doesn't seem to work that way in practice.
That's the practical refutation the critique makes. In the current debt money system, for the government to actually spend money to make payments that will clear it, absolutely must have the funds available in its account first.
And how does it get those funds?
It has to borrow first. It issues treasury bonds, those IOUs, sells them to the banking system, and gets deposits credited to its account. Then it can spend. If it tried to spend without securing the funds first, payments would fail.
So in reality, under the debt money system, it's borrowing comes first.
That's the operational reality the critique insists on.
Yeah.
MMT might be describing a theoretical possibility, but it's ignoring the practical constraints and sequencing of the existing system.
Which implies that the only system where spending comes first could actually be true is
the public money system, where the government genuinely issues its own interest-free currency directly.
And the critique provides a contrasting balance sheet for that scenario, too.
Yes, to highlight the difference, let's quickly walk through that again using the 80 billion yen example. Imagine a public money vault, or administration, PMV, is authorized to create money.
Sure.
Step 1, public money issuance. The PMV creates 80 billion yen. It records this as its own asset and also its net asset, since there's no corresponding liability. This newly created interest-free money is then directly transferred to the government's deposit account.
So the government now has $80 billion ready to spend, and importantly, its own net asset position is positive, or at least not negative from this operation. It didn't have to borrow.
Correct. No debt incurred. The government is ready to spend, holding genuine equity.
Step 2, spending. The government spends the $80 billion into the private sector.
Right. And on the balance sheet, that net asset initially created by the PMV flows through the government's spending action and lands directly in the private sector's accounts, increasing both their deposit assets and their net assets equity by $80 billion.
So comparing the two systems, debt money spending created a private asset, but also a government liability, leading to future interest taxes that drain private wealth. Public money spending creates a private asset, and a private net asset increased directly with no future interest burden.
Exactly. It's a direct injection of debt-free equity into the private economy. It creates national wealth without the built-in mechanism for wealth transfer via interest or the accumulation of government debt.
This is why the source argues MMT spending comes first is fundamentally a description of a different system, public money, being incorrectly applied to the current system, debt money, where borrowing comes first.
That's the crux of the argument on sequencing.
Let's bring this back to the real world with that Japan case study. The critique uses flow of funds data, especially during the Abenomics QE period, roughly 2013-2019, to show who the government is actually borrowing from and why it matters.
Yes, the shift in who holds Japanese government bonds, JGBs, during that QE period is really dramatic and revealing.
What were the biggest changes?
Two huge shifts stand out. First, the Bank of Japan itself became, by far, the largest holder of JGBs. Its holdings absolutely ballooned, jumping 2.5 times from about 200 trillion yen to nearly 500 trillion yen.
That's the quantitative easing effect, the central bank buying up government debt from the market, mainly from commercial banks.
Exactly. QE fundamentally altered the landscape, taking huge amounts of government debt onto the central bank's balance sheet. This obviously helped keep interest rates pinned near zero.
Okay, so the BOJ stepped in massively. What was the second big shift revealed by the data?
It's about who the government stopped borrowing from, or borrowed much less from. Holdings of JGBs by domestic public pension funds, which are technically part of the government sector itself, absolutely plummeted, dropping by over 50%.
Why would the government reduce borrowing from its own pension funds? That seems like an easy source.
The critique argues this was a very conscious, rational strategy by the government. They understood something important from mainstream economics.
Which is?
That borrowing heavily from domestic non-bank entities like pension funds or insurance companies is exactly where the mainstream Keynesian theory of crowding out applies most strongly.
The idea that government borrowing competes with private investment for a limited pool of savings, driving up interest rates.
Precisely. If the government had continued borrowing heavily from pension funds, it likely would have pushed up interest rates, potentially triggering the very default scenario mainstream economists warned about. It would have validated the mainstream critique of high government debt.
So by deliberately avoiding borrowing from those non-bank domestic sources and instead relying on the BOJ and commercial banks, whose lending creates money endogenously,
they successfully kept interest rates artificially low, despite the massive government debt levels. And this, ironically, became MMT's Exhibit A. MMT proponents could point to Japan and say, see, high debt doesn't cause high interest rates.
While the critique argues it was a deliberate policy choice to avoid proving the mainstream theory right, not proof that MMT is inherently correct about rates always staying low.
That's exactly the interpretation, a strategic maneuver that MMT then took as validation.
But if you reduce borrowing from domestic pensions, and there's a limit to how much the domestic banking sector can or will absorb, the source says it stays relatively stable around 45–60% of total debt, where does the government turn? Who becomes the lender of last resort?
This is the critical shift the data reveals. Overseas lenders. Foreign holdings of JGBs surged during this period, increasing 1.8 times to reach 147 trillion yen.
147 trillion yen. That's a huge number. What percentage of Japan's total government debt did that represent?
Around 12% by the end of that period. That's 147 trillion yen, or roughly 1.17 million yen of debt owed to foreigners for every single person in Japan.
And the consequence of relying increasingly on foreign borrowing.
This leads directly to what the source calls the fourth catastrophe scenario. It's no longer just about internal wealth transfers. When a significant chunk of your debt is foreign-owned,
The interest payments flow out of the country entirely.
Exactly. The Japanese government has to tax its own people, its own productive economy, to collect funds that are then transferred abroad as interest payments to foreign bondholders. This is a direct drain on national wealth year after year.
Leading to
National impoverishment, a loss of economic sovereignty, and potentially eventual default when foreign lenders lose confidence or demand higher rates. It mirrors the classic debt traps that have plagued many developing countries reliant on international capital. Hashtag 4.2 money as a means of control.
This reliance on foreign capital isn't just about the economics of interest payments, is it? The critique suggests it opens the door to foreign influence and control.
Yes, it connects the financial flows to potential shifts in power. It points to the structure of the primary dealership for JGBs, the big institutions that underwrite and trade government debt.
What's the breakdown there?
The source notes there were 9 Japanese prime dealers versus 12 foreign prime dealers.
So more foreign firms directly involved in managing Japan's government debt market.
Yes, and significantly, the critique highlights that 10 of those 12 foreign dealers are institutions that also appear on lists of the world's top 25 entities with major controlling stakes across global corporations.
Implying these aren't just random foreign banks, but players with significant global financial power and influence, now deeply embedded in Japan's government financing.
That's the implication.
Yeah.
They are strategically positioned. The critique suggests they have an interest in ensuring Japan continues policies that require ongoing debt issuance because they benefit directly as underwriters and potentially as holders.
And this isn't just about government debt. The source also tracks rising foreign ownership of Japanese companies, right?
Yes. The data on corporate shareholding trends is presented as another piece of the puzzle, showing a major shift over the last few decades, coinciding with Japan's economic stagnation.
What does that data show?
Foreign ownership, overseas sector, of Japanese stocks surged dramatically. It was only about 3.5% back in 1980, but by 2019, it had climbed to 18.6%.
Wow. Nearly 1/5 of Japanese corporate equity held by foreigners, making them the second biggest shareholder group.
Yes, second only to corporations holding shares in each other. Financial institutions excluding banks and insurance, which often includes cross-holdings. Meanwhile, look at who lost ground. Japanese household share dropped from over a third, 33.7% in 1980, down to just 15.4%.
So the average Japanese citizen owns a much smaller piece of their own national economy, while foreign ownership has skyrocketed.
That's the trend. And the critique draws a direct line from this increased foreign ownership to the pressures faced by Japanese workers.
How does foreign shareholding translate into, say, wage stagnation or precarious employment for Japanese households? What's the mechanism?
It's driven by shareholder expectations, particularly the demand for higher returns and dividends. Foreign institutional investors, holding nearly 20% of the market, exert significant pressure on corporate management to maximize profits.
And the easiest way to boost profits quickly is often
to cut costs. And the biggest controllable cost for most companies is labor. So the argument goes, this pressure leads companies to prioritize cutting wage bills, often by replacing stable, full-time, regular employees with lower-paid, less secure, non-regular or part-time workers.
Which directly contributes to household income stagnation and a feeling of economic insecurity, even if GDP isn't collapsing.
Exactly. It systematically impoverishes the domestic workforce to satisfy the dividend demands of shareholders, a growing portion of whom are foreign entities, including those international banks involved in the JGB market.
So the critique concludes with a really stark warning here about MMT's role.
It does. It argues that MMT practices, by encouraging and justifying massive government debt accumulation, inevitably lead to greater reliance on foreign borrowing. This, in turn, increases the leverage and control of these international financial players over both the nation's finances and its corporate sector.
And the force connects this to a broader geopolitical agenda.
It makes the provocative claim that this trajectory aligns with what it sees as a globalist push towards eroding national sovereignty, potentially aiming for a single world currency managed by global institutions. In this quite dramatic framing, MMT isn't a solution for nations, but rather an unwitting minion helping to dismantle national financial control.
Okay, MMT isn't just about macro theory. It does propose concrete policies to address social problems like unemployment. The most well-known is the Job Guarantee Program, the JGP.
Right, the idea of the government acting as an employer of last resort.
Guaranteeing a job to anyone who wants one, usually at a minimum wage, often linked to things like the Green New Deal. It functions as an automatic stabilizer. Spending goes up in recessions, down in booms.
It sounds socially beneficial on the surface, ensure full employment, provide a wage floor.
But the critique we're examining is deeply skeptical of the JGP, isn't it? It sees it as another flawed approach within the debt money system.
Yes, it analyzes JGP through the lens of systems thinking, specifically identifying it as a fixes-a-fail archetype.
Meaning it looks like it's solving a problem, but it actually makes things worse or creates new problems down the line.
Exactly. It's treating a symptom while ignoring or even exacerbating the underlying disease. The critique raises several specific problems with JGP within a debt money context.
What's the first one?
Problem 1. Symptomatic treatment. JGP tackles unemployment, which the critique argues is just a symptom of the inherent instability and boom-bust cycles caused by the debt money system itself, especially fractional reserve banking. JGP does nothing to fix that underlying monetary instability, so the cycles will continue, requiring the JGP perpetually.
It patches the hole but doesn't fix the leaky pipe.
Precisely. Problem 2, debt accumulation. How are these JGP jobs funded? In the MMT framework, it's through government spending backed by debt issuance. The critique argues many JGP jobs might be low productivity, the old Keynesian hole-digging criticism.
Meaning they add to government debt without contributing enough to real GDP growth to service that debt sustainably.
Right. So JGP, while providing employment, could massively accelerate government debt accumulation, potentially leading Japan, for example, from a lost 30 years into a lost 40 years of stagnation under an even bigger debt mountain.
Okay, so it addresses unemployment but deepens the debt crisis. Are there social critiques as well?
Yes. Problem 3, stalled innovation and control. There's a concern that a large-scale permanent JGP could create a more passive society, overly dependent on government employment.
Reducing dynamism and risk-taking.
Potentially, yes. If there's always a safe government job available, it might stifle the entrepreneurship and innovation needed for a truly vibrant economy. It also concentrates enormous economic power in the hands of the state, deciding who works where and on what, potentially reducing individual agency.
And the final critique is more philosophical, about the nature of work itself.
Problem 4, labor as a commodity. This is quite interesting. The critique argues that MMT, even with a JGP, still operates within the standard microeconomic view, where labor is essentially a commodity, an input, maybe even a necessary pain to be bought and sold.
Okay. And the alternative view.
The source contrasts this with what it presents as a more traditional, perhaps idealized Japanese management philosophy, thinking of things like lifetime employment, the company as a community where work isn't just about wages, but a path to self-salvation and bliss, a source of dignity, purpose, and belonging.
And the argument is that the debt money system, with its focus on short-term profits and cost-cutting driven by interest payments, destroyed that more humanistic view of labor.
Yes, forcing labor to become disposable. And the JGP, while providing income, doesn't fundamentally challenge that labor as commodity view. It just makes the government the buyer of last resort for that commodity. It doesn't restore the lost dignity or purpose in this perspective. #STAG 5.2 macroeconomic model comparison, AST model results.
So if JGP isn't the answer, according to the critique, how does it test the proposed public money solution against the MMT debt money approach?
This is where the source uses its own macroeconomic model, called the long-run endogenous money ASD model. It simulates running the Japanese economy forward under two different policy regimes after a period of stagnation.
Comparing the MMT approach, presumably continued debt finance spending, maybe including JGP, versus a shift to a public money system, interest-free money issuance.
Exactly. Line 4 in their charts, the dotted pink line, represents the debt money MMT solution. Line 3, the green line, represents the public money solution. They look at outcomes for GDP, prices, money supply, and government debt.
Okay, first off, does either solution manage to get the economy growing again based on the model? What about GDP?
Interestingly, yes. The model shows that both approaches initially succeed in restoring GDP growth, getting the economy back towards its potential path, like the Japan as #1 era growth trend.
So in the short term, just stimulating demand works regardless of how it's financed.
It appears so in the model, yes. Both can kickstart recovery, but the crucial difference lies in the sustainability and stability of that recovery over the long run.
Let's look at the debt money MMT solution, the pink line first. What happens to the other variables?
It paints a pretty grim long-term picture, consistent with the critique's theoretical arguments. While GDP recovers, The money stock just keeps growing exponentially.
Because the system relies on ongoing borrowing and interest payments keep compounding?
Exactly. And government debts also continue to accumulate relentlessly, heading straight towards that debt hell scenario. And crucially, what happens when the money supply grows exponentially faster than the real economy?
Inflation.
Or worse.
The model shows exactly that. The price level diagram for the MMT solution shows it taking off vertically. Hyperinflation. The model concludes the MMT path within the debt money structure is fundamentally unstable, unsustainable, and leads to catastrophic failure.
Okay, pretty definitive result from their model. Now, what about the public money solution, the green line? How does that play out long term?
It shows a path to stable recovery after the initial injection of interest-free public money needed to boost the economy.
The money stock then stabilizes. Yes, because ongoing spending isn't reliant on exponential debt growth. It can be managed to match the economy's needs. And because the government is issuing money interest-free, not borrowing.
Government debts remain at zero.
Correct. The government debt line stays flat at zero. And most importantly for stability, the price level after the initial adjustment also stabilizes. No hyperinflationary takeoff.
So the model simulation supports the critique's core argument. Only a fundamental shift away from debt money towards public money can provide both economic recovery and long-term stability without runaway debt and inflation.
That's the conclusion drawn from the ASD model comparison. It presents the public money system as sustainable and equitable, while framing the MMT approach within the debt money system as inherently unstable and ultimately destructive. Hashtag tag 5.3, the four system design failures of debt money. Summary.
So, to bring this all together, the critique essentially argues that MMT seems appealing but is ultimately a false theory because it tries to patch up the problems of the current debt money system without addressing, and in fact, by actively hiding its fundamental design flaws.
And the source identifies four core interconnected design failures of debt money that MMT allegedly ignores or obscures by defining money as debt from the outset.
Okay, let's quickly recap those four failures. What's the first one?
Failure number one stems from fractional reserve banking, the ability of private banks to create and destroy the vast majority of money supply, debt money, out of thin air when they make loans.
And this causes
an inherently unstable money supply. It expands rapidly during booms as banks lend eagerly and contracts sharply during busts as loans default and banks pull back, guaranteeing these persistent, damaging business cycles of inflation and deflation.
Okay, unstable money supply. Failure two.
Failure two is how the debt money system forces governments into debt hell. Because the government has to borrow money into existence at interest to fund its spending, it inevitably gets trapped in a cycle of accumulating debt and needing ever-increasing taxes or more borrowing just to pay the interest.
Leading to austerity measures that hurt the population.
Exactly. It structurally necessitates fiscal policies that afflict the people.
Failure number three.
This one is about inequality, compound interest. The very nature of charting interest on debt money acts as a relentless mechanism to transfer wealth.
From whom to whom?
From the productive economy, households and businesses who borrow or pay taxes to service government debt upwards to the financial sector, the lenders, the bankers, the 1%. It builds unfair income inequality right into the monetary system's DNA.
Got it. And the fourth, failure.
Failure four connects to sustainability, the unsustainable growth imperative. Because debts, both private and public, require paying back more than was borrowed, principal plus interest. The system forces producers into a constant, relentless drive to expand production.
Just to generate enough surplus to meet those ever-growing debt service obligations.
Precisely. It creates a structural need for perpetual economic expansion, often regardless of the environmental cost, resource depletion, or actual human need. It forces us to chase growth simply to keep the debt system from collapsing, ultimately threatening the ecosystem.
So the overall argument is MMT fails because it operates entirely within this flawed system, ignoring or even justifying these four failures, while public money aims to fix them at the root by changing the nature of money itself.
That's the fundamental contrast presented by the source material. Hashtag #outro.
Well, we started this deep dive looking at modern money theory, and it's really compelling promise. You know, the idea that governments that issue their own currency have this huge fiscal freedom.
The magical money tree potential.
But by carefully unpacking the specific critique, the one arguing from a public money perspective, we've seen the entire debate really hinges on a fundamental distinction.
Yeah, the difference between a government borrowing debt money that comes with interest strings attached versus the potential for a government to issue its own interest-free public money directly.
And this critique argues that our current debt money system isn't neutral. It's designed, whether intentionally or not, in a way that systematically transfers wealth upwards through interest and builds in fragility through debt cycles and the potential for inflation or default.
Right. And the conclusion from this source is that MMT, because it accepts the money is debt premise and, according to this critique, lacks a truly coherent long-run model that accounts for private debt creation and interest. Well, it doesn't offer a stable way forward.
Instead, the critique claims it actually risks accelerating the negative consequences, deepening inequality, increasing foreign dependency, and ultimately leading towards national instability.
That's the core warning.
So hopefully, after walking through these 7 falsehoods and the underlying mechanics, you, the listener, are better equipped. Not necessarily to agree or disagree wholesale, but to recognize the key definitions, the assumptions, and the systemic mechanisms at play whenever MMT or sovereign debt comes up in discussion.
Yeah, you can now ask those critical questions. Are we talking about borrowing or issuing? Where does the interest payment flow? What are the long-term consequences of this debt accumulation versus a potential interest-free alternative?
It helps you see beneath the surface claims.
And this brings us to a final, maybe more provocative thought, stemming from that critique of the Job Guarantee Program and the nature of work.
The idea of labor as just a commodity.
Exactly. The critique suggested that the debt money system, with its relentless pressure for growth and cost-cutting to service interest, inherently treats human labor as disposable, as a cost to be minimized, a necessary pay in exchange for a wage. So the question to leave you with is this. If we could shift the monetary system away from interest-bearing debt, perhaps towards something like the proposed interest-free public money, could that fundamentally change our relationship with work?
Could it allow us to move beyond treating labor purely as a commodity?
Could we restructure our economy, our companies, our social values so that work becomes less about just surviving the market and more about that path to self-salvation and bliss, that source of dignity and fulfillment the critique alluded to? What actually need to change beyond just the money system for that vision to become a reality?
That's a deep question about the connection between our financial architecture and our human values.